Welcome one, welcome all to the Sunday Night Deathburger Show, unfortunately presented on Monday due to some technical difficulties with the uploading. Yes, grab a smoke, grab a toke. Apparently our president is a little stressed out, and the Deathburgers might help him swallow those Marlboros as the markets are not cooperating with his hope and change. In the Dow this week, as you can see, we seem to have hit a minor technical headwind, and this particular chart formation is very nasty, where you have a large white candle followed by a large red candle and then a what looks like a hammer or hanging man, depending on your interpretation. It's definitely not a pretty picture. What it usually means is it's a very negative short-term formation, and what will happen to the markets usually is either a brief rollover for the next 3 to 6 weeks, or a bounce down, a spike back up, failure to reach these current high levels, and then another turn downwards. Time will tell, and the holidays screw it up. S&P 500 reflects the exact same pattern, which it should, which means we have consistency in the markets, and the NASDAQ is even in worse technical shape. So, Mr. President, you better smoke as much as you can. The price of those smokes is about to get a lot more expensive. Let's shift over to the precious metals, getting away from equities for a minute. As reflected by the GLD, an even worse technical pattern has appeared, with gold appearing to be set to break down severely. Now, I'm use that with a touch of a pause of tentativeness. I don't think it's going to be as bad a breakdown as others say, but the support levels are pretty solid, with intermediate support around 1120 to 1128. Long-term support in the 1050 to 1080 level. You could even go down as far as the 1020. Silver, on the other hand, had a very positive week. Could continue to rally based on an industrial basis. I think we retest the $29 to $30 area before we see a similar pattern formation and a rollover in the silver market. This week should be the make or break week for it going into the end of November. If you look at the 2-year weekly charts, which is what I'm using tonight, short and intermediate support puts the long-term support above 1950. The short-term and intermediate support around $20.50. Silver is in a very sound financial pattern, and it all ties to the currencies. Now I'm going to give you a brief look at what's happening with those currencies. It's an interesting thing. Copper just confirms the gold down move, by the way. I just thought I'd throw that in there. The currencies tell you something different. The UDN, or the bearish ETF, shows a breakdown in that particular market, paralleling the S&P 500, Dow, copper, gold, everything else. I think that the dollar is poised for a nice rally here. The events this morning seem to verify that, as the entire Irish rally fizzled overnight, and the UUP is also confirming it too. When you look at the bottom right-hand corner, I show a V-shaped bounce. We hit a new low intraday. We bounced up. The man hanging there, that little candle from last week, doesn't mean it's over, but I tend to think that we're going to head back up to the two red resistance lines, possibly seeing a good 20 to 30% gain in the U.S. dollar on the UUP, the ETF, over the next couple of weeks. Let's look at the foreign currencies to get a better idea. The Australian dollar formed an almost identical pattern to all of our equity markets and gold and copper, etc., etc. Not silver, however. The Australian dollar had a huge rally, has hit a pretty good all-time high in recent since the FXA was issued, and should sit there and roll over now. I think the FXA, or the Australian dollar, should come back down and test the low 80-cent level. Once that test is over, a retest of the recent highs is possible next year. In the Canadian dollars, I see a further breakdown of the Canadian dollar. Didn't insert the second chart on this, but the Canadian dollar, I think, has a chance to go back to 86 cents on the U.S. dollar and test the long-term consolidation. This is a very toppy pattern and probably will break down severely. On the euro, if you see the lower right-hand corner where I had the blue shaded area, I think that the euro is going to come back down and test the crisis lows between 119, possibly even 117, and 126. It's going to be a wildly fluctuating market. As you can see from the candles during the initial breakdown, we didn't get back to the original highs from over a year ago. This 2-year chart pattern shows a failure to even top the chart high 2 years ago. I think it breaks down further. Next, the Swiss franc. It's due for a massive correction and reconsolidation. I think we're gonna head back to 96, 90 to 92, maybe even lower. I'm putting that blue zone up there. The Swissies don't want a strong franc. They'll love the Europe cratering. They're going to help it go along. Lastly, the Chinese market has been in a very toppish pattern. The blue area is an intermediate level where I think it's going to decline. Once it declines into that level, it's a make or break proposition. If we break down, we're going to go severely to the downside and hard and take world markets with it. If we don't, it's going to come back and make new highs. I tend to lean towards the latter scenario. The Chinese do not want a strong economic scenario presented. They want to bring their markets down a little bit. They're going to let it crash. Into the financials, which is the key story. American Express gives you a hint as to what's coming. Look at American Express. It's got a long-term consolidation underway, but there's no underlying fundamentals to support it. I think the target by Christmas is going to be substantially lower, even though it might be early next year. The area that I have circled is a target range, which is a 50% haircut of American Express. I honest to God believe the retail sales figures are going to come in very disappointing, and look for a surge of insider selling going to year end. I don't think they're going to pass the tax cuts. They're going to sustain the tax levels that Bush passed, and that's going to cause a cratering of the financial stocks. Speaking of cratering, Bank of America made a nice intermediate term high, recovering from the lows of 2009. As you can see from the steep lows, it climbed up with a liquidity pump. Now it's starting to decline in a stair-step fashion. This sucker is poised to crash. To be quite honest, I think Bank of America is a candidate for a 50% haircut also. If this sucker isn't trading between the $4 to $6 range soon, I'll be shocked. The real estate situation is killing it. The lawsuits are killing it. There's no backing from the government any longer. They have lost all validity to hold these lofty levels, and I honestly to God believe the price-earnings ratios are way overinflated. And you can see that in other financial stocks. The next stock we're going to look at is Citigroup. Citigroup is sitting here trading only because they keep creating more stock and issuing it, and the hedge funds and banksters are buying it up. In reality, it's due for a 50% haircut. I think we're going to see something in the $170 to $2 range, probably in the next 60 to 90 days. My personal opinion, don't take my word for it, just a gut check based on the technical formation and the lack of sustained fundamental recovery. Goldman Sachs had to insert this morning. The news was bad. They're in the investigation, possibly for insider trading. Allegedly, now we have the hedge funds being raided. You have all this news breaking later on today. And what's going on? It's due to come back and correct and test that consolidation range in the blue. JP Morgan, same deal. 30 to 40% correction coming due. They're holding a lot of crap from Washington Mutual. It's not a sustainable level for this stock to trade at until if they don't have to market or actually reflect the valuations of their holdings, it's going to be fine. But when you start looking at other stocks like MetLife and Insurer, we'll focus on insurers next week, it's holding a ton of commercial real estate REIT and other municipal issues. These people are going to get burned also. The insurers are facing the next great crisis because their investments that were allegedly safe are the ones that are going to get toasted. Let's go over to Morgan Stanley real quick. Same scenario, haircut coming, I think 30 to 40%. Just a gut check opinion. Again, don't invest based on the information I provide. Seek a certified financial professional. Morgan Stanley is looking putrid. Absolutely putrid. And that's why I'm concerned about its ability to hold those levels. They do not have any business going forward. PNC Financial, same thing. They acquired banks, which are in the hellhole. It's not going to hold for much longer. They're going to have to sit there and adjust their balance sheets, and any kind of investments in municipal bonds, etc., are going to get corrected. Look for a total move out of those particular issues. Regions Financial, the southeastern states, worst thing. The blue zone I have there is below the $2 level. Yes, I think Regions Financial is a candidate for zero, only based on their real estate holdings, the lack of sustainable cash flow. As long as the government's going to let them make creative finance their thing, that's what's going to happen. And of course, the Walking Dead Synovus Financial, a stock which is stair-step down from its recovery highs. If you look at the dives that it's taken, lower lows, lower highs, the candlestick formation, horrible, below $2. When it's below 2, you're through. Below 5, you're barely alive. When you're below 1, you're done. Look for a below 1. It's the Walking Dead. Lastly, U.S. Bancorp. U.S. Bancorp is also due for a haircut. It made some acquisitions. It hasn't made the transition to sit there and get the garbage off their books. Once the garbage is off their books, they'll be fine. They're one of the stronger financial institutions. However, let's go to one that has been playing extended pretend. Wells Fargo, you see the nice V shape, the long right hand extension, yet they haven't taken the hit for Wachovia's garbage and crap. This is just my opinion. Again, if you need investing advice, seek a certified financial professional. But I think Wachovia is due for a 30 to 40%, possibly even 50% haircut before this is all said and done. Because Wells Fargo isn't even talked about their seconds, their auto loan business, or anything else. Stay tuned. And now for your Municide follow-up to last week. Yes, the vast wasteland known as our cities is continuing. We're going to hit some of the big bad boys from last week's feature, starting with BlackRock's Municipal. You see from the BlackRock Municipal Income Investment Quality Fund, we came down severely. These are one-year weekly charts. Those candlesticks are brutally ugly. I think we have further room to the downside. We may retest the lows from last December as faith in the ability of the cities to repay, the counties, etc., is starting to fade. The market vectors high yield municipal index ETF also took a beating, breaking down on an intraday basis, on an intra-week basis, its lowest lows. I think we're going to go ahead and take it on down all the way. These are total technical breakdowns, and as you can see from the the PIMCO Municipal Index Intermediate Municipal Bond Short Strategy Fund, it's breaking down severely also, though not as severely as the market vectors or the BlackRock. But there's nothing to support it. It stair-stepped up on the idea that there would be infinite liquidity from the government, and now they're starting to realize it's not there yet. The PIMCO Municipal Income Fund, same story, breaking down severely. We've broken through a 6 to 9 month low. I think we're going to see this thing come down even further. There's nothing to support the municipal complex because the people don't have the money to pay their bills. Tune in Monday through Friday, now at new times from 7 to 9 p.m. Eastern at the Watchman.fm for the Voice of Galt. We're going to follow these stories closely. On the Monday night program, we're going to have an update from Ireland, which is in total chaos, where the letters I, R, and A are coming back into vogue. Remember, the Watchman.fm, Monday through Friday, 7 p.m. to 9 p.m. Eastern Time for the Voice of Galt. We're going to have some follow-ups to all of this because there's a real risk of a total breakdown in the financial sector. God, I hope not. I really hope and pray it doesn't happen. But it does appear that the situation has become extremely unstable. You can tune in, listen for more. We're starting Monday night, tonight, 7 o'clock Eastern. For the Voice of Galt, this is John Galt speaking. Good night or good afternoon, ladies.